Recording in progress.
Yani ahora mismo.
I can hear you.
Chief Deputy Auditor.
Olivia Crowe, Chief for the Safety Leaders Unit for the local government support team. And safety helpers, I work with the state auditor's office and I'm the manager at the local government support.
Tired. I wish I could like snap out of this. Long-term debt in the governmental funds. It's a type of asset. Oh man, let's see. So tired. I wish I wasn't so tired. Let's see, we got 3 more hours. What can I do? Wish there was something.
That's what I like.
Yeah. I've never tried that before. I don't drink much. I'll follow along, because I got, at least 2 that
Yeah, good.
I'm not.
I know.
I'm good. I'm good.
That's really fun. I,
Oh. Huh. So that's how it will go.
you know the small sign,
Oh,
small thing. But yeah, they know what it's like. But I want to get like 50%. That's not bad.
I try not to get.
Pretty good. Yeah, really, but I can't go there.
Yeah.
I almost got a Robert Jones.
Yeah.
GFOA. There's that book. Capacitance.
I have a long train of paper clips. What's that?
The state auditor. Okay. What does that mean? What is this tax called? I think it's rural county capital. Rural county capital 1440. So what I need is what the state. For public facilities. Oh, nice. Schedule 20. Schedule 20. Who puts this together? Grace. Where does he get this info?
Testing 1, 2. To our friends in the virtual audience, can you hear us now? Oh yeah, you can hear us. We did it. The round of applause. Yes, yes. Our friends in Spokane appreciated the applause. So, all right. I think we can take it. Thank you.
Thank you all for your patience. This portion will be added on to the end. So, you know, dinner will be, no, just kidding, not really, not really. So first, our first item on the agenda is the 2025 BARS update. And we are so grateful for the continued collaboration and participation that we have with our local state auditors and their staff. And they are here to teach us, to remind us, to let us know what's changed, and to help us with our financial statement reporting. Oh, so, Olivia, are you first? Oh, perfect. And so you all met Olivia a few minutes earlier. So thank you. Thank you, Olivia, for coming. And if you need it, let us.
Okay, I'm gonna get the screen switched over here. All right, just in time, I will give it back to Stacy. I would like to thank, no, hi, we were chatting and then, oh, it's time. Guess what? Well, we're here to talk about all things accounting and reporting. Isn't that fun? And I hear you have us like the whole afternoon. So I like to ask the questions. We like to have lots of questions. Don't be afraid to ask the questions. And if you want to be anonymous, that's okay. So Stacy, I introduced myself. I'm waving at a camera that's somewhere. Where's the camera? I introduced myself earlier. Hello, there we go. So local government support team, you probably all know and love us. We answer a lot of your help desks. We train a lot. We have lots of videos. So you've probably seen and heard us often. Well, we're going to talk about what's coming 2025 for BARS. But before we get there, we want to recap the two big things that happened in 24, because you're all doing your annual report, right? We've all clicked start at least. Yes. Okay, good. Lie to me, it's fine. And then we'll get into the 25 updates. And then I have a few reminders for annual filing. As you are all actively filing your annual reports, we just want to make sure you know some things. Does that sound good? Thanks for having us, by the way. We love to come see you all. Okay, 24. Do y'all know the two big things that happen? Like pop quiz. You're all like, yes, Stacy, we know. Okay, well, the first one is accounting changes and error corrections. We have lots of videos, lots of resources, so I'm not going to dig too deeply in this because we have all of that available to you. But we want to highlight to remember that there's 4 categories in our accounting changes and error corrections. There's some new bars codings that we'll talk about in a minute. And one of these, y'all raised your hands, so there's only a few of you that are GAAP. One of these is GAAP only. So cash, you don't have to concern yourself with one of those categories. So here's a summary of what it looks like and what happens in the world of the financial statements. So that middle column really is our GAAP people. And so let me talk about this. So changes in accounting principle, these are things changing in the cash bars manual, our GASB statements. We tell you to do something new. That's a change in accounting principle. For you GAAP governments, that's a retrospective application, which means you have to restate all of your periods. This is where cash is like, yes. This is not a change. When accounting standards were implemented for GAAP before, most often it was a restatement. They would tell us in the standards. So that shouldn't be too much of a change for people. We do have bars codes attached to these. So cash and GAAP, you use the same bars codes to identify the impact of these changes. That's the 38850 and 58850. Now, changes to or within a reporting entity, we get a lot of questions on this. This is things when you're moving, like funds. I have a fiduciary fund that now needs to be a special revenue fund, or vice versa. Or you're moving an activity. Like this activity is now just going to go to the general fund. That's that's a change in your reporting entity. There is a special code for this. For GAAP governments, this is a line item adjustment on your financial statements at the bottom. For cash, by the way, all of these cash there go to your net adjustment line on your C4 and C5. That's where all of these roll up. Now, the change in accounting estimate, GAAP only because you do all accruals. Sometimes there's a change in that estimate of how you've done that accrual. Current period only. There's no prior period. Oh, sorry, strike that from my vocabulary. We don't use that term anymore. There's no adjustments from the prior year. It's just a current year change. So use your functional bars codes for that. And then I know y'all hear error correction. We all think bad, right? It's not bad. It's just there's an error. There's an error in the math. There was information that maybe you should have been made known to and you just weren't. And we made an entry last year. We have to fix it this year. It's fine. Errors are not bad things. You have found something and you're fixing it. So there's a new bars code. It actually removed the prior period adjustment bars code. The new bars code is 38830 and 58830. So again, GAAP and cash, you use all the same bars codes, and it's just your treatment on your financial statements that will be a little different. The notes also are updated in the bars manuals for both our GAAP and cash manuals. There's a narrative version and a numerical version, and they are required for both components are required. The narrative tells the story. Why did this change? Like, what's the nature of the change? What's behind the change, and why? Why did this change? And then the table format gives the numbers. It was this fund, it was this much, it was an error correction, it was a change in accounting principle, whatever the item is. And then it gives the totals. So everybody can just kind of trace through what happened here. And there's some great examples in our notes on this, so I hope you check those out. And the coming in fiscal year 2024 page is still active. It's what's called a project page for our bars manual. We put the information about the standard, links to the bars pages, links to the videos. So we have a QR code if you want to take a picture and go check it out. It's also, if you go to the landing page of sao.wa.gov, click the bars and annual filing, you'll see the landing page for what's coming in 24. Ooh, people are taking photos. They're doing a big QR code. I'm probably not even in the photo. It's okay. All right. Now, accounting changes in the error corrections. We're good. Everybody okay? It wasn't like compensated absences, right? You're like, yes, we're good. Okay, compensated absences. I'm really excited that 24 has happened and it's closing because we've been talking about this one for a really long time. We're very happy to be moving on to new subjects. We also realize you're still implementing this. So we want to make sure that you know that you have resources. We are here to help you. And I want to give you some highlights of compensated absences. And for GAAP, that is GASB 101. So let's just start off with a reminder of the definition. So compensated absences is defined as leave that an employee may receive a cash payment for when they take time off. They may receive a cash payment for a situation like they are leaving service and here's your check for your unused leave. Or what's called a non-cash settlement. It's generally when it's cashed out but goes to something like a VEBA or like a healthcare post-retirement type of an account. It's cash going to an account that they'll use later. So it's a non-cash settlement in that the employee is not getting a check from you. And then along with this, we're looking at leave, the balance, so leave that has not been used by the end of that period. And it's leave that's attributable to the services rendered by the employee. So I get asked sometimes, what does that mean? I don't know if any of you ever had signing bonuses to bring on people, or you're bringing on somebody and they're like, I will come, but you need to give me 40 hours of leave. And you say, okay, fine. That is not attributable to services rendered. So you would not include those. This is the accrual over the year that you earn while working. So those are the balances we're talking about. Accumulates over time and does not zero out at the end of your period. And there is a likelihood you're going to pay it out or they're going to use it. And when they say this 50% or more likelihood, that's always a fun, how do I figure that out? Am I going to pay this or not is kind of the question you're asking. Is it really like 0% chance I'm going to pay this or more? So if you haven't already started, please look at your policies. And even if you have started, it's a really good idea to go review your policies, make sure that the math you've done, the worksheets you've set up, all of that good stuff still aligns with what your understanding of the policies were. So you're looking at when can they earn it, how can they use it, when do I pay it out, at what percentage do I pay it out, etc. And another thing is to look at your trends. So we always say a trend is anywhere from 3 to 5 years. Anything less may not really be a trend. Anything more has a lot of anomalies in it. So about a 3 to 5 year trend, but we'll want to also be careful here. We are in 2024 reporting. We still are looking at COVID years in our trends. So some governments may have experienced a lot of leave uses in 2020 and 2021. So you may want to look at trends and then the historical information that you might want to take out of those trends. So trends are fun, right? We like trends. So you're looking at your data so you can figure out what this liability number is. Now, cash governments, leave that's been used at the end of your fiscal period, but you haven't paid yet. Prior, you've probably not done anything with that, but that's going to be part of the liability calculation now. So a lot of governments, maybe they are the 16th through the 31st, then they pay in the new year. If somebody uses leave, you want to make sure that that balance is added to your liability because you're paying it out in a future period. You are liable for that payment. GAAP has already been doing this. They do this with all of their accruals. Most likely this number is in their accrued wages, which is totally fine to keep it there. If you do move it to your compensated absence liability, just make sure you're consistently applying that going forward. So we want to make sure we're calculating our leave balances off of the rate of pay as of the last day of your reporting year. Even if you know you're getting a COLA on January 1st, it's what is the amount as of the last day of the reporting year. The only caveat to this is we have seen a few policies that say, we'll pay this out, but it's at 25% of their current pay rate or at 50%. And we see that a lot with sick leave. That is the only time you would reduce the rate of pay. So we want to also include in your calculation salary-related payments. And what are those? Those are things that are direct and incrementally related to wages. Stuff like your employer responsibility of payroll taxes, not the employees. Your employer responsibility for payments to health savings accounts or flexible spending accounts. Remember, do not include the employees portion because that's not part of your liability. And any payments that the government makes to defined contribution plans. Do not include all of the DRS pension plans. So like the PERS, the LEFs, those types of plans, because those are included in your pension liabilities that are an actuarial analysis, and we can go down that path, but we won't. But they do calculate leave balances depositing into those plans. We're also asked this a lot. Do I have to worry about bereavement leave, family medical leave, the PFML leave, all of these other leaves that are available to employees, but they don't happen to every one of us. They don't happen all the time at the same time. They're sporadic and periodic. So no, you do not include these types of leaves. You do not have to try to look in your crystal ball and figure out who's going to take what when. The only time you worry about these is, let's say it's December and you have an employee go out on parental leave and they're going to be gone for 4 months and they're going to use all of their leave. That is the only time you include that in the liability because you have a known event that's carrying over into the next year. But you don't have to try to forecast that person in June. No, I don't know that anybody in June is going to take their leave balance for this type of a situation. You don't need to do that. BARS has been totally updated. We have new sections for compensated absences. We have examples of some common leave policies that we've seen and how to calculate the liabilities. So I highly encourage you to go check those out and kind of follow through those steps. The Schedule 09, it was always required for compensated absence liability. That code has not changed. So it's still the 25912. We want to remind you that you can net. So you'll have your beginning balance, which is the balance from last year. You can net whether it went up or down and put that in the appropriate additions or deductions column. You don't have to try to figure out what you added and what you reduced. So yay for that. And then it should automatically calculate your ending balance in the Schedule 09, which should match your spreadsheets. We've also made some changes in the notes for changes in long-term liabilities for both GAAP and cash to include compensated absences so that those numbers can be disclosed and discussed. And then you'll also notice Note 1, which is the summary of significant accounting principles or policies, which is SSAP. I hope you're all looking at this note every year. We always make fun updates to the SSAP to make sure that you're disclosing policies. And compensated absences is a policy, and you'll want to put in there certain information like how leave accumulates or how it's paid out. We have time, right? We have some time, right? You're all friends at your table, right? If you're not, we'll be in a second. Okay, we're going to take a couple seconds. So I want to first break the ice. So amongst yourselves at your table, chat about the first question. What have you all done so far? Like take a couple 30 seconds, a minute. We're going to see about the buzz in the room here.
We also have a question online. It says, are employer match contributions to employer-sponsored 401A and 457 plans included in leave liability calculations? This is from Mark Lane. He says, I seem to recall in a prior training that only match contributions to non-sponsored defined contribution plans are included.
401. Yeah. So if their plan, so we don't want to confuse ourselves with, is it a 457, a 401, those types of things. If they are defined contribution. So if they are saying, I'm looking at you, look at the camera. Hi, Mark. If you are saying, I will put $50 into this plan for these people, then that is a contribution you include. But if it's a defined benefit, which is I'm going to retire and at some point you're going to give me this amount of money for retirement, those don't get included.
And he said, yes, they're both defined contribution plans.
Yes. So then you would want to include your portion of what that amount would be. Thank you for clarifying.
And one other one just said, did we go over how CPE works?
Oh, I am unable to answer that question, but I'm sure that our education co-chairs can. CPE.
Well,
They will.
We're going to go back into CPE at the next break, and Chandra will get it. Sorry, guys. That was for all the online people.
That's great. We will make sure you get your CPE. It's valuable. Do y'all talk amongst yourselves? I got all chatty with the online folks. Did y'all start? Have we started? Yeah. Okay, good. So show of hands, and it's okay, be honest, because reading this was difficult.
Who found this difficult? It's okay. We can close our eyes and you can raise your hands and then nobody will see. Everybody online, close your eyes. Was it difficult? No, they said it was all easy. Well, then why are we here? Let's talk about what's happening next year. Yes. We're getting a microphone. There we go.
My question is I've been reporting this for a long time on my schedule. And has anything changed? I mean, because we look at leave balances and then we pull all of the bargaining agreements where you can cash out a certain amount of sick leave and convert it to annual leave, et cetera, like all of that. What has changed? Did I just do this?
No, you didn't. That's all good. So in a lot of instances, most governments did not pay out sick leave upon termination. That's pretty common. So one of the big changes of this is now we're trying to account for sick leave that's going to be used in future periods. Your employees have earned that. It is a benefit to them that we are liable for. So that's why that's been rolled into this liability. Now, what may also be added into that is that you've been calculating what might be paid out or converted, but it's that usage. That's what we're finding is the biggest change is if it's not a full cash out, like vacation is usually, if you leave tomorrow, we give you 100% of what's sitting there. That's been the easy calculation. It is the usage of leave that is not cashed out when they terminate. That's the biggest change. Great question. Okay, so we've started. We didn't find this overly difficult. Does anybody have a challenge or have had challenges that they want to just share how they got over them? Or you all are just like, yep, Schedule 9 is done. Okay, we have a hand.
For the S part of things, to make things easy,
It's cutting in and out. He's gonna fix it. You can ask and I'll try to repeat.
it's the last payroll of the year. It's 3 of the days are actual days. So, I wanted to just put 30% salary.
No. So you have a pay period that's split over the end of the fiscal year. You working?
Yeah,
There we
so
go.
I just had to turn it on. Yeah, so 30% of the days are in 2024 and 70% in 25. I guess I don't understand why it has to be so exact. I mean, it seems like from a standpoint of your financials, it's going to be close enough to just say as if 30% of those salaries was 2024. I don't know if you've come across any comments on that or not, but that was my biggest frustration.
That's great. And the one with this is a known event that's happened. So actuals are now available to you, and it's always better to use actuals than do estimates. And you could probably run some checks on this because I don't want to say anything is right or wrong, but I would run checks of what actually happened versus that 30% and see if your numbers are significantly different. And if they're not, document that and say, this is what we're going to do. We will check this every year just to make sure it doesn't materially change. And that could be part of your policy or procedure to calculate this number. It needs to be reasonable and documented. So whatever you've all decided to do, just make sure you can document it. You can follow it every year. You can explain it to your auditor, and it seems reasonable for your situation. All right, good. Any questions from all right. So again, same QR code if you missed it from last time, that what's coming in 24 page, links to the training, links to the BARS manual. There's even a link to the help desk. We are here for you. Please don't be afraid to ask us questions because we want to make sure that your implementation goes as smoothly as possible. I think Olivia wants to come talk to you all. She's very excited.
Up here. All right. Thank you, Stacy. So she covered the stuff that was last year that's in your report that you're filing now. So now we're going to switch gears and talk about the stuff that's coming for 2025. So this year, what do you need to do? Our chart of accounts section, there's actually a lot of pages in this section. You probably don't use all of them. We're going to just look at the entire section here, all the pages in it, and clean it up and just make it more logical, like put things where it would make sense for you to find it. We're not making big changes to the content here, just how it's organized to make it easier for you to find what you need in this section. And along with that, every year we look at our BARS codes, the titles and descriptions, and we try to update those and make them a little bit better. That way it's easier for you to select the right code. Determining fiduciary activities. This one doesn't have a section title because we're moving it. Right now it's in the reporting section of the BARS manual. We're going to put it over in the accounting section. The accounting section is where we have the other guidance on the fund types and how to use them and when to use which one. So we're just going to put this with our other fund guidance. And in our overview of changes page, it will have the number for you, so you'll be able to find it when we move it. But again, not making any substantive changes to the content, just moving where it's located. For capital assets, so this one's for cash only because this is actually already in the GAAP BARS manual. So the guidance isn't really different between the two bases. We're just giving cash a little bit more guidance on capital assets. We're really just clarifying when you start capitalizing costs. We get a lot of help desks on this, like, well, when do I capitalize costs? When do I use that capital expenditure code? Once you identify a specific asset, that's when you start using your capital expenditure code for anything related to that asset. So if you're doing feasibility studies, or if you're researching to figure out the best location to put a new building, those are not capitalized because at that point in the process, you haven't identified a specific asset. Once you pick that location, or once you know you're going forward with the project, now you have a specific identifiable asset and you start using that capital expenditure code for those related costs. Okay, money held in trust. This page talks a little bit about court trusts. There's an RCW that says if you're holding money, basically for someone related to a lawsuit, you're holding money for them, you're not supposed to put it with the rest of your money. You're supposed to put it in a different bank account, and the RCW calls that a clerk trust fund. Trust fund means something very specific for accounting, but the RCW doesn't know that. So the RCW calls it a trust fund, but that doesn't mean it automatically qualifies to be reported as a fiduciary trust fund. Most of the time, this is just going to be a normal custodial fund. So we're going to clarify that in this BARS page. The other thing that we're going to do in this BARS page is we're going to add guidance on when you deposit money with somebody else. So right now it only talks about when you're holding somebody else's money, but sometimes you give your money to someone else and they're holding it in a trust for you. The most common example we see of that are payments to escrow accounts. So as an example here, maybe you have to pay earnest money and it gets placed into an escrow account until the sale goes through. Well, when you put that money in the escrow account, you don't actually have an expenditure at that point. You're just moving it from your bank account into this trust account. So somebody's holding your money for you. So there's no expenditure at that point. You're really just, now you have cash held by a fiscal agent and it comes out of your normal bank account. But your total cash balance is really the same still. You don't record that expenditure until the escrow money is actually paid out. So like until you purchase the item. So that's when you actually record that capital expenditure. Next is our interfund loan section. So sometimes counties, you issue registered warrants for your junior taxing districts. They don't have quite enough cash to cover their expenditures, so you cover it for them. There is an RCW that says, yeah, you're allowed to do that. And it's also listed as one of the allowable investments for you. But if you want to call it an investment on your financial statements, you have to meet the criteria in RCW 3959. That requires a monthly analysis to determine the market value of the registered warrants and update the interest rate charged. Most of you probably don't want to do that every single month for your registered warrants, right? So most of the time, if you're issuing registered warrants, they're not reported as investments. They're going to be reported as an intergovernmental loan. So for GAAP basis, that means you're reporting a loan receivable. For our cash basis governments, you have a cash outflow code that you would use for that. But don't report it as an investment unless you're meeting those criteria in the RCW. Next is our solid waste utilities. So this is if you're operating a landfill. We just updated this section to include more accounting guidance. So especially in the cash manual, it mostly just had some compliance information, like what Department of Ecology expects from you. So we just added the information in there, like, hey, if you have a landfill, you have a liability that needs to go on your Schedule 09. So we included that information in there for you. And as a reminder, that landfill liability should be updated each year. So on your Schedule 09, you would update it, and you would have a related note disclosure. For interest, petty cash, and other revolving funds, this is another section that has a lot of control guidance, a lot of compliance guidance, but not a lot of accounting guidance. So we're just going to be updating the section to give you more of that accounting guidance. As a reminder, if you have any petty cash or revolving funds, they really do need to be reconciled and replenished as of the fiscal year end. You should do reconciliations more often, right? Monthly, but it's really important at year end to make sure you're getting those expenditures reported in the right fiscal year. And when you're looking at your ending cash balance that you report to us, it should include the full authorized amount of those petty cash accounts. So we have an example. We get a lot of questions about how do I set up my petty cash? What expenditure code do I use? Well, you don't use an expenditure code when you set up your petty cash, right? You're basically pulling money out of your bank account and maybe you're setting it in a change drawer at your county. Your total cash has not changed at that point. So this is another situation like we're just moving cash around. There's no expenditure at this point. So let's say you use your petty cash fund, you take $85 to go buy stamps. You don't have an expenditure to record at that point. You record your expenditures when you replenish the petty cash. So it's important to keep good track of what you're using petty cash for. That way when you go to reconcile it and record those expenditures, you know what the right bars code is to code that all to. Any questions so far? This update year is a lot easier than last year. Equipment rental revolving, another section that has a lot of really good compliance and control information, but we want to add more accounting guidance to this section. So really, if you have an equipment rental and revolving fund, it's set up basically to rent out equipment to other funds and departments. So it's set up specifically to provide services to those other funds. So that means when your equipment rental and revolving fund is receiving money from those other funds, it needs to report a revenue because it's providing a service. And those other funds and departments are going to report an expenditure because they've received a service. GAAP basis only, you have a special section in the reporting portion of BAR's manual for internal service funds. We're just going to take a look at the reporting section and the accounting section and make sure that there's no duplicated information and that the pages are synced up so your accounting stuff is in the accounting page and reporting is in the reporting page. For deposits and investments, so this shows up in a couple places. Your note 1, that summary of significant accounting policies, it talks a little bit about like your investment policies, and then you have a whole separate note that talks about your deposits and investments. We did a project where we looked at all of the county's notes, and we found that there's a lot of variance in what type of information is being reported in that deposit and investment note. So we're going to take a look at our current instructions in the BARS manual, and we're going to update that, give you more clear guidance on what it is we're expecting in that note. That way, hopefully everyone can report about the same information. Certain risk disclosures. This is a new note. This is actually required from GASB 102. So for GAP people, you might know it from there. You have a new disclosure requirement only if all three of those items and those bullets are met. So the first one there, a concentration or constraint, is known. Most governments have a concentration or a constraint, right? A concentration could be maybe there's one major employer in the area that employs everyone in your vicinity, or maybe your revenue source is concentrated to only a couple sources. For constraint, that could be things like limits on raising revenues, limits on issuing debt. So most of you will have that, right? There's a limit on how much you can increase property taxes. There's a limit on how much debt you can issue. But that does not mean you need this note disclosure, because we still have to look at the other two criteria. And the second one is that you're vulnerable to the risk of a substantial impact. So that means like if you have a concentration, like an employer in the area and they would shut down, is that going to be a big deal to you or not? The answer is no, not a big deal. You don't need to worry about this note. The answer is like, yes, it could be a big deal potentially. Like if the only military base in the area shuts down, most people are going to be unemployed or move. You're vulnerable to a substantial impact. But we still have to meet the third criteria. And the third criteria is that there has to be some event, something that has to happen. So that would be like the military base actually announcing that they're closing. If they haven't done that, you have no event, nothing to disclose. This note is really only for like super big impacts to your government. These are things that you're going to know about. You don't have to disclose every little concentration or constraint, only if you have some big event. If you do have some big event, the disclosure, you're basically just going to describe what that is. What's the concentration or constraint? What happened? And if your governing board has taken any actions to mitigate that impact. For our cash basis governments, we're adding a new note disclosure for you for short-term debt. So this is debt that maybe you've issued in the year and then you repaid it later in the year. We want you to disclose that in the notes now. It's really similar to your long-term debt. You basically tell us the beginning balance, additions, reductions, and ending balance. GAP, you already have this note requirement. You have a note for this. So we're basically bringing it over for the cash governments too. And this is only for like debt issued, right? This is not for every little short-term liability, right? You're not going to report your accounts payable here. You're not going to report your wages payable. It's actually if you go out and borrow money from somebody, that's what we want in this note. Risk management note, this is another one where there's a really big variation in how much detail governments are giving us. Some governments disclosure has like several pages that disclose all of their insurance coverages. Other governments have a couple sentences in there. There's just a lot of variety. So we're going to review the requirements, like what are the minimum requirements that need to go in this note, and update the instructions and hopefully make it more clear to you what it is we need in there. Okay, this one's for cash only, cash governments. You have a note that's just called other disclosures. This is basically a catch-all for anything big that might happen at your government that we would want you to disclose here. GAP governments, you don't have this like other disclosure catch-all note because most of the time GASB has a lot of disclosure requirements for you, so you're going to have a separate note template already. So for our cash basis governments, this is really just a reminder. Please look at the other disclosures every year. Just review the items in that note and determine, Does any of this apply to me? Do I need to include anything from this disclosure in our notes? And because you're all busy and I know none of you are going to go look at this note, we're going to look at it. So gap governments, again, this stuff is stuff you would absolutely disclose. You're just going to already have a note template in the BARS manual for you. So special and extraordinary items, this is when something really big or significant happens to your government. It could be like a natural disaster, discontinuing a major program. So if you have to shut down one of your departments, if you merge with another government or take on a bunch of extra responsibilities, if you have a really major sale of a capital asset, anything that's reported to the BARS 385 and 585 should have a related note disclosure. That's our special and extraordinary BARS code. You should only report things to that code if it's really big. If it's not significant, you can use your normal revenue expense codes. So if it's really big and you're using this code, make sure you have a note disclosure to explain what that is. Another thing in this note is contingencies and litigation. So if there's a reasonable possibility of an unfavorable outcome, you should include some information in your notes. That's like if you have a claim that exceeds your insurance coverage, or if there's a huge deductible you have to pay, you should disclose that. So if you're going to have to pay out a big amount, that should be in your notes. If you have disallowed grant expenditures and it's significant to you, if you have to pay back a lot, you would want to include that. If there's any disputed contracts that could have a really significant effect on your operations, you should disclose that. For this one, please consult your attorney, talk to them. What are the big things in here? Make sure the stuff you're putting in the note is okay. You don't want to disclose too much information, right? It's just if there's a big impact to your government, your citizens want to know about it. So you should have something in there for them to see. Subsequent events. So these are really big things that happen after fiscal year end, but before the audit report is done. Most of the time, that's you issue new debt. So if your fiscal year end is December 31st, and then on January 15th, you issue $50 million of debt, people want to know about that. So you're going to include it in your notes, even though it's the next year. It's only for the really big things, though. You don't need to disclose every little event that happens after fiscal year end. It's just the really large things. Significant commitments or obligations. This is basically like if you've signed some contract and you know you're going to have to pay on it, you want to disclose that. The most common example are construction commitments. If you've signed a contract where you're going to be paying out $30 million in the future, you can't really use that cash for other things, or you're committed to it. So you want to disclose that. And this table down here is just a sample of what you could disclose. It could be really simple. You have a project, you're reconstructing a new city hall or a county hall. Tell us how much you've spent to date and tell us how much is remaining on your commitment. How much more are you going to have to pay out for this project? Other things, any sort of government combination, merger, acquisition, transfer of operations, could be related to an annexation or if there's any redistricting or reorganization. And then anything else that's really big. So that means use your professional judgment. If you have some event happen at your government that's not on one of those lists, but it's something that a citizen would care about, you should disclose it in the notes and give them information about that. Your notes are there to really tell the story of your government, what happened over the year. So use your notes to tell the citizens what happened. Any questions on those? Yes. They're on the way.
Okay, so for the, I guess it followed or like the other disclosures. So you gave a couple examples of like City Hall with remaining commitments of 30 million. Kind of like a two-part question. So, because a lot of this is subjective, like I know my budget, I know what I think is significant, but are there any thresholds associated, like 10% of operating, 10% of general fund? Or is it just kind of like what we think is matters?
It's professional judgment.
Okay.
So basically, if it's something that you think citizens will care about, if it's large, impactful to you, you'll want to disclose it. But it does involve some professional judgment. So you can talk to other people at your government or talk to your audit team about it, and they'll be able to help you make that choice.
Cool. And then the second part of the question is, so like here's a real world one. So everybody might have heard of Cle Elum's predicament right now. So I'm Kittitas County Auditor. So that seems like it might be one that we would add. A lot of the analysis and the risk mitigation, we have like a little internal work group that's meeting on this. It's sort of like hypothetical. Like if they go bankrupt and they don't have a police department anymore, there's a sheriff's office commitment to ensure public safety. And so is it worth like trying to quantify all that stuff as like a hypothetical analysis for the purposes of this, or just like more of a general overview of like, hey, this is a thing that we're aware of and we're trying to mitigate the risk?
I think the general one is a better in this specific instance.
Sure.
You don't want to do hypotheticals and start projecting out numbers or trying to figure that kind of stuff out. If you have information that you know, like it's going to cost this much, then you could just include that, but you don't have to try to like look in a crystal ball and figure out what's going to happen.
Cool. Thank you.
Any other questions? All right, I will pass it. Oh,
We have one online from Mark again. What about court rulings such as proposed new indignant defense standards being considered by the state Supreme Court that, if enacted, would have a significant impact on indignant defense costs counties would have to incur to comply with?
so if there's going to be a really significant cost or impact to you, you could disclose that in your notes. But again, it's something that you would need to like know is happening. Like there's an event that's happened, you know it's going to cost you a lot of money, it's going to be a big deal. You could include that in the other note disclosure. Anything else? Okay.
All right, thank you. Ooh, she left me her notes. That's okay. All right. This is a new section, but not new information. We like to put that out there so you don't all go, what are you doing? Managerial funds and the concept of managerial funds is sort of spread out all through the BARS manual in a couple different places. And what we want to do is take that guidance, bring it into one single section, and then make sure we fill any holes that might be out there. So we are going to start looking into this, doing some research, and it is our hope by our fall training series, when we start going to the fall conferences, we will have more information on exactly what we're doing here. But right now we know we're consolidating into one section. That is always a goal, is let's make it easy to find stuff. So more on that to come. And I know you're all just dying to see the lists, right? So every single year in the BARS manual, under the alerts and changes section, we keep a list of every change we make in the BARS manual, unless it's spelling errors. But no matter how small, it gets put in the chart. So if you go out there to reporting year 2024, you can see every change that we made. And then we keep this for 5 years. So you can look back to 5 years worth of changes that we've done. And then every year we put on BARS updates. So we come out here to see our friends. We also do recorded ones. So you can watch it, you know, in the middle of the night when you can't sleep, you know, insomnia, go ahead, watch our videos. We have the ones for 24 out there. We generally record these in October. We post them by the end of October is our goal for 25. So you can know everything that's happening and start planning. And that is on our training and workshops page. So that landing page of the sao.wa.gov, BARS and annual filing, you hover over that menu, you'll see the trainings and workshop page. All of our videos are out there. So we hope that you are watching them. Any questions about the updates? So we constantly monitor. I heard a question about some of the proposed legislation that's coming. We constantly am monitoring the legislation that's coming out of Olympia. the end of session, we see what's been passed and is there any sort of impact to our local governments that we need to put in bars. So we are monitoring that. So as soon as that is known, we add it to our bars update list and we start bringing that information out as soon as it's available. We also constantly monitoring the federal environment, the GASB environment. So we never stop looking for things that are going to impact you and making sure we're trying to provide the best information possible so that you can file, right? Look at that segue. I practiced that one. Let's talk about filing. So May 30th of this year, it's a Friday. You're all welcome. It's not a random Tuesday after Memorial Day. Again, I apologize. The RCW is 150 days after your fiscal year end. So we're sort of hands tied to that 150 days. But this time it's May 30th. And with that, as you're getting into your annual reports and you're starting your 24 reporting, you go, oh, I need to make a change to last year. Something is incorrect. Did you all know that you have the ability to unlock your annual reports at any time up until the point your first audit report for that year is published? It can be your accountability. Unfortunately, it could be a fraud report. It could be your assessment. It could be your financial, whatever. But as soon as a 23 or a 22 or a 21 report is issued, you have to come to us and say, please unlock this for me. How do you know this? Well, if you log in, so thank you to this city who is our volunteer to be on our slides today. If your unlock box is blue, you have the ability to unlock your own report. If it is gray, you need to reach out to your audit team, say, I need to unlock it. This is why. They need to assess what type of audit they just closed to make sure there's no impact to the audit. And then they can send an email to us, or you can send an email to us where you've CC'd your audit team and said, I've talked to my auditors, please unlock my report. And our filing team will be more than happy to do it for you. So some reminders of what has happened. So in the Schedule 01, we brought back, we all launched the newly refreshed system last year. There were some requests for this missing report that you could export the list of required and warning errors on your Schedule 01. We have brought that back. You should be able to download that. It does help with researching. That way you're not going back and forth in the filing system. You get a little Excel document. You can research all your BARS codes. So that is available to you. The Schedule 09, who's done their 09 already? Stacy has. Okay. In the Schedule 09, we have added a question. So the first question is, do you have liabilities to report? And you say, yes, I do. Another question is going to come up and say, do you have a continuing disclosure deadline that we need to be made aware of? And then there's a fun little question thing that you can hover over, and it basically tells you bond reporting to Emma, or any other need for audited financial statements to give to the people who lent you money, your investors. If that is a yes, a little drop down comes of when is that due? Is it June 30th? Is it September 30th? Or is it some other random date that you can plug in? This lets us at least know that we need to make sure to check with you on when you need your audit so we can try to help you get those audited financials in a timely manner. So some yes, no questions, super easy. If you don't know if you have a bond reporting deadline, find out who's in charge of your debt at your counties and ask. We also have the 09. It's funny because when we tested this, we're like, oh yeah, everything's fine. Apparently not. We missed displaying required errors to fix on the 09. Duh, right? So we have fixed that. So now if there's a required variance error that needs to be fixed, and just the warning ones like, hey, by the way, those are now displayed in the 09 on that page. So we brought that back too. So thank you to everybody that let us know that we missed that, because we need to fix it. So again, if you have any suggestions for filing, Kaylee loves to hear from you. Please let her know. Now, we all love the CFA, the Schedule of Expenditures of Federal Awards, or the Schedule 16. This has gone back and forth depending on what the federal government needs. Well, we finally just decided this is just easier. There's another award ID column. We've just opened it. Now, if you have indirect awards, it's going to require that you put the ID in there. And if you have direct awards, it's not required. But you don't have to remember that. Just other award IDs you include. You can include it. It's okay. You're not going to get, no, you can't put that there. But just so indirect awards, those are required. That is how the federal government IDs when we upload. And it's a whole thing with is it ID.me and all of those fun places where your CFA audit goes. So other award ID is open. I apologize to all of you who had required awards and it kept telling you no. We have fixed that. We hope that that takes away some of the angst on the CFA. Okay, we talk a lot about trainings. So when you land on our training and workshop page, you'll see there's 4 hyperlinks to take you to areas. There's lots of filing trainings that we do during filing season. Actually, today is Tuesday, so the last one went today for cash. Thursday, if you're free, we're doing the last gap one. It's a walkthrough of the filing system. We have our e-learning section. That's where all of our videos are. We have many, many videos, a lot of intro videos, our bars update videos, Lisa's, Spida, all those fun things. Those are all in those e-learnings. I encourage you all to check those out if you have questions. And if there's not a video for your question or topic, please let us know because we are always looking for what needs to be put out. So let us know. Questions, comments, concerns? Is our online community quiet? Are you guys there? Just put it in the comments. Yes, Stacy, we're awake. No questions. We've just given you all of the information. You're probably like, we want a break, right? Bio break. Okay, well, here's our information. We're going to leave this up because I think we're to a natural break. I think there's a discussion about CPE, and then I'll let you guys tell us when to come back. How's that? We're headed to a microphone.
Yes, we're going to do a 10-minute break and then we'll come back for the next section. And for CPE, for those online, your attendance is being tracked by the team here. So that's how you're going to get your CPE through there. So we'll see you in, what? 2:45. See you in 10 minutes.
I had to find the voice moved into a different spot.
Oh, okay.
Okay, so if you go to the A drive,
Yeah, okay.
behind all these monitors here.
Yeah.
And then, let's see. And then let's go into audit.
Okay.
And then that year-end reporting.
Okay.
And then go down to leave liability.
Okay.
And then 2023 was the last one I did, so you'll have to do.
Okay.
So what I did, if you want to open up the first, there's not that one, but that one.
Okay.
Okay. So the sheet 1 is the raw data.
Uh-huh.
So that's out of the leave liability report out of Eden. And I can,
Okay.
you're not too familiar with Eden, are you?
I don't know this report settings.
So
yeah.
I can run that for you for both sick and vacation and send you the whole report.
Uh-huh.
And then the working one is how I sorted it.
Okay.
At the top of it, you'll see kind of how I sorted, I think by salary group.
Uh-huh.
And then, you've got my notes over there in column K, if it's 25% over 10 years, 3
Uh-huh.
years max. But you're going to have to want to look at each of the CBAs as of 24 and make sure that those are still applied for those particular groups.
Okay.
And then, like for instance, down there on row 21, that gentleman has 992 hours. We're obviously, because we're only going to cash out up to $5,000 max. So
Okay.
whatever, that leave liability is 35,000, which
Uh-huh.
is not going to be our true liability because we're only going to max out the 5,000 if he were to leave.
Okay.
Does that make sense?
But what if he was just to call in sick for an extended period of time?
Well, we never know. I mean, we're just, I don't know what Eileen did. I just
Uh-huh.
gave her the information, so I'm not sure which one she reported.
Uh-huh.
I think what they're looking for is as of today, as of December 31st,
Uh-huh.
if they were to leave on that date, what's our liability? I think is kind of how the state looks at it.
Uh-huh.
So if he were out an extended period of time, that could go out months. And we're just only looking as of December 31st, what the liability would be. I think that's how they look at that, and that's why we had to do that.
Okay.
So I will get you those vacation report and the sick leave report, and then you'll do.
I mean, won't they just be the same as these reports here?
No.
Oh.
Vacation's gonna be different than sick leave.
No, I mean, this one says vacation, right?
Right, so if you open that one up,
Uh-huh.
they're gonna have different leave balances.
But I mean, what I mean is, for 2023, which is the year we're currently working on, it's not going to change from this report.
Oh, I thought you were looking for 24.
No, we're not there yet.
Okay. Yes, that is the data then. So with vacation, they get all of their vacation up to 240 hours. So some of those you might, on that working document, you might find where I had done a limit. If somebody had over 240.
Oh, okay. 240.
Yeah, you see that one that's highlighted there?
Yeah. Uh-huh.
So he had 262 in his bank, but 240 is the cash out limit.
Okay.
So yeah. So those are 23s. So yeah, you've got what you need then, I guess.
Okay. Would you be able to show me the settings to run the report?
For a leave balance report? Yeah, go into Eden. Okay, let's go payroll. And then reports, leave, employee reports.
Okay.
And then leave balances, I think is what you want. Okay, and then,
Do I just hit the lightning here?
yeah, let's do that.
Okay.
Okay, and then report type over here, you want leave liability.
Okay.
Let's see, include inactive paid employees. I don't know if you want that one.
Oh, I don't?
Because it's already termed,
Mm-hmm.
because we're gonna run this. You're gonna change the date up there. Next to where it says PA, you're gonna change that. And let's go to query by example. Oh, shoot, this isn't. It's gotta be the report. End date. Due and end date is 12/31. You want 23 or?
Yeah, 20,
Okay, just okay, let's go that. Click that, lightning bolt.
Okay.
Okay, and so, yeah, let's go, and then just double click on there. That'll change your date.
Okay.
You use prior rate, you want that marked. Okay, I think that's how you would just run that. So let's go ahead and view it on with the light, that little magnifying glass up there at the top.
You can't segue fund. Okay. Okay. I want to print fund summary. Will that affect anything?
I've never run it that way, so you can check it and then
Okay.
just view it. So go up there to the lightning, that little magnifying glass there, and let's look at it.
Okay. Isn't it going to take a really long time?
No, not for December. It shouldn't be too bad. Do you want to use reporting imbalances instead? So you can change.
I think yes, right?
Do you want to use? Yes.
I'll let you know when it's done.
Yeah, it should go fairly fast, but yeah, take a look at that and see.
Okay.
Yeah, I've never run it by the fund balance because, the fund wasn't anything that I ever did anything for her with, but maybe it'll help you out.
Yeah. Yeah, I need that for the ISF funds, the internal service funds.
Okay. All right, we'll see if that helps you.
Yeah, thank you.
At the, well, like, why are they they can use the extra.
Okay, I think we'll get started if everybody can take a seat.
Make sure. Are online folks back? Good. All right. We could do our yoga stretching, our chair yoga while everybody gets settled. Okay. Interfund activities accounting. We need a different name for that. That's a lot of words. We have found that we have been lacking in providing interfund activities training. It's something that we're wanting to focus on, especially in the BARS manual, just clarifying and cleaning up. So we are bringing to you today interfund activity accounting. And a side note, Olivia here has a cash and gap one recorded that she's transcribing. So when you want to send all of your friends in your departments to this training, it will be online for you. So what we've done is combine this so we have both gap and cash into one slide deck. And we're going to talk about what are they and give you all the definitions. talk about reciprocal, which will be a definition we'll talk about, and non-reciprocal transactions, and then just special topics related to interfund activities. We're just scratching the surface today, so we'll probably leave you with a lot more questions than you thought you would have. So I'm going to start with the introduction of interfund activities and oopsie. Whoa, I got excited on the arrow key. On the definitions, okay. Slow down. There we go. So we have to start all the way back to fund principles. And if you've been to any of our BARS classes or watched our intro to BARS video, this will kind of be a refresher. But when we start with fund principles, it will then help make sense interfund. So fund principles. So a fund is a self-balancing set of accounts. All of your debits must balance to all of your credits. Right, we got the little scale there. So this is within each fund. So individual little house is what I like to call it. So when we talk about interfund activity, we are just specifically talking about activity from one specific fund to another individual specific fund. And these are funds that you are going to report on your financial statements. So when the transactions happen over here in this fund, it's a debit and a credit, and then there's a debit and credit in the other fund. And when you have like 50 funds, that's a lot of credits and debits, right? So our fun little picture, separately reported funds. The general fund might have a transaction with a special revenue fund, that might have a transaction with the utility fund, that might go back to the general fund, all separate entries. So very briefly, which, we're going to have that new BARS section on managerial funds. When you have a managerial fund, they might be separate funds in your accounting system, but at the end of the day, they consolidate or roll up into a single reporting fund. So when that happens, it's called intra-fund activity, and that is fully eliminated. You don't want to report all of those things between these funds because technically they're not individual funds. So the concept of managerial funds is something that it can cause some confusion when we're doing interfund activities. So you'll have to think through that step as well. But for this class and for this training, we're going to really just look at separate funds and their activities. So I kept talking without changing the slide, which I'm famous for. So here was some images of the intra fund. Olivia needs to throw stuff at me when I do that. Okay, so inter-fund activities, separately reported funds that are going to show up on your C4s or that you are going to show in your combining state financial statements. They are individual funds. They have not been consolidated into other funds. So under that activity, we have two categories, and then we have four types. So we have reciprocal and non-reciprocal. So reciprocal includes all of our interfund loans and services that are provided or used between funds. And non-reciprocal are the things like transfers and reimbursements. So the correct definition of reciprocal is exchange. You're getting equal value for something you are giving up. That's not the technical definition. That's Stacy's watered down version. So for example, the general fund buys water from the water utility. You are getting water and you're paying cash for it. So equal exchange. Non-reciprocal is I'm giving you something and you had to do nothing for it. So here's $1 million from the general fund to go do whatever you need to do. That is the non-reciprocal. So we see that a lot with transfers. Oh, I'm done already. Here comes Olivia. She's gonna dive deeper.
Okay, we're gonna start with the reciprocal interfund transactions. First is loans. So these are when one fund lets another fund borrow money. And it's reciprocal because the fund that gives up money, they're gonna get repaid and a little bit of interest, right? So they're getting something in return for letting this other fund use their money. there should be some sort of loan document, typically a resolution or an ordinance that lays out this loan has been authorized. Here's the dollar amount of the loan. Here's the repayment schedule for it. Here's how long it'll take to be repaid. Here's the interest rate. All of those types of things should be in the original loan document. When we're talking about interfund loans, we expect them to be short term. I know typically in financial statement reporting, that means a year or less. But with interfund loans, we really mean 3 years or less. And that's just kind of a general guideline. If you have an interfund loan that's longer than 3 years, that's not necessarily unallowed, but your auditor's going to look at that and make sure that it truly is a loan that will be repaid instead of a permanent transfer of funds. Interest should also be charged in basically all cases. The fund that's giving up money, they don't have to loan it to that other fund. They could be investing that and earning interest on it. So there really is an opportunity cost when they loan that money, so they should charge interest in most cases. We're going to look at the accounting entries, and we're going to start with our GAAP governments. So in GAAP, the loan or the fund that is borrowing money, they're going to report a liability. So they receive cash, they debit it, and then they report a payable. They owe the other fund money. This is true even in governmental funds, even if the loan is more than a year. Normally in government funds, you would not report your long-term liabilities, but interfund loans are an exception. You always report a liability for that in your governmental funds. Lending fund, the other side, they report a receivable, right? The other fund now owes them money, so they're going to report a receivable. And we use the terms interfund loan receivable, interfund loan payable. These balances are reported separately on your financial statements, separately from your borrowings from other external parties. So interfund activity should be separate from other stuff. Now, when you're repaying it, this is pretty easy. Borrowing fund, you have to repay it. You're giving up cash, you credit cash. The payment, though, is broken up into two pieces, right? You have the principal piece that reduces your payable, and then you have an interest expense that you would report to your BARS code. Lending fund, same thing. You're receiving cash now, and when you receive that payment, you're breaking it up into the two pieces. You reduce your receivable for the principal portion that you receive, and then you report an interest revenue in that fund. Sometimes, though, those loans aren't always repaid. GASB tells us that if you do not repay your interfund loan, that's actually a transfer, right? Which makes sense because you're not repaying it anymore. That fund just gave up money. So if you're ever in the situation where you're like halfway through your loan and the governing body decides to forgive it or whatever, they decide we're not repaying back some of this, you would have this situation here. You're basically going to convert your loan into a transfer. So the borrowing fund, they're going to get rid of the rest of their payable or however much of the payable that has been decided they don't have to repay. And the other side of that transaction is a transfer in. It's basically just reclassifying this to the right interfund activity. Lending fund is the same thing. They're going to remove that receivable from their books, and the other side of that entry is going to be a transfer out. And this really only applies to the GAAP governments. So no cash governments, your borrowing fund. You don't have receivables, you don't have payables, you don't report those on your financial statements. So we're going to report cash inflows and cash outflows. So for your loan received, that's a 3.8 code, which is like a other financing. For the lending fund, same thing. You have a special code for the loan dispersed, a 5.8 code. For the borrowing fund, when they repay, again, cash goes out the door. For the principal portion, you have BARS 581.20, and the interest expense would go to 592. So you're still splitting it out between that principal and interest. And the lending fund does the same thing. When they receive that cash, they're going to receipt the principal to the BARS 381 and then the interest revenue. And we will provide these slides to you. You will have them. Okay, any questions on loans? Loans are usually straightforward, right? You know when one phone borrows money from another. Yes.
Do you switch that over? Oh, sorry. Do you switch that over to a 397,597 also?
So the question is for cash basis. If the loan's not going to be repaid, do you switch it to a transfer? The answer is no for cash because there's no cash flow in that transaction. The fund's not repaying, there's not cash moving, so you don't have to report that. In your notes to the financial statements, you should have a table that outlines your interfund loans. So there would be a decrease in that table, and you'd want a note that explains this loan was forgiven or whatever the situation is, but no entry in the accounting records. Other questions on loans? Okay, we'll talk about the other reciprocal transaction then. This is services provided and used. So this is one fund selling goods or services to another fund, and it's a part of their regular fund activity. It's what that fund was created for, and you just treat it like normal revenues and expenses, just like if you had went out and purchased goods or services from an external party. Some examples of this could be a park fund renting a recreational facility to the water fund. So if the water fund is having their annual employee appreciation at the park and they want to rent a facility, they're going to pay the park fund for that. The park fund will report a revenue, that water fund reports an expense. It's part of the park fund's normal operations to rent out those facilities. If a sewer fund is providing sewer services to like the police station or other general fund departments, that sewer fund gets to report a revenue for that amount. And the general fund will report an expense, just like if they had to pay an external party for sewer services. And internal service funds, so we talked about the equipment rental and revolving fund in the BARS update this morning. That's an internal service fund. So when you have internal service funds, they're set up specifically to provide services. So when they provide those services, they're reporting a revenue, and the other funds are going to report an expense. We'll take a look at the journal entries. So the providing fund, again, they get to report a revenue. Most of the time, this is going to be a charge for service revenue, which is a 340. There might be other BARS codes that make sense in your specific situation. So take a look at your BARS codes. And if you need help figuring out the right code, you can submit a help desk and we can help you with that. For a GAAP governments, you can report a due from other funds. So if that fund doesn't pay you right away, then they owe you money for that service. So you would have a due from other fund. Cash, that doesn't apply to you. You just report the transaction when the cash exchanged. The fund that gets the services, they're reporting an expense or expenditure to their normal functional BARS code, whatever BARS code they would normally use. And then the credit is to cash, or for GAAP, again, if it's not paid right away, then they have this liability due to other funds. They owe the other fund money. And again, these liabilities are inter-fund liabilities and receivables, so you report those separately from like your accounts payable or accounts receivable. Any questions on inter-fund services provided and used? How many people here have a internal service fund, right? Most of you, all of you? Yeah. Okay. So that's it for the reciprocal transactions. Now Stacy will talk about our non-reciprocal.
Thank you. Okay, so non-reciprocal transactions. So these, remember, are transfers and reimbursements. So transfers, these are really simple. These are simple ones of, I think, most of these. So it is a transfer of cash from one fund to another fund where there is no expectation of repayment. There is no expectation of a service to be provided. It is simply, here is cash to go do whatever you need to do. So the transfers must equal. If you transfer cash out, there needs to be a transfer in. The transfers must always equal. So check those, check your bars codes. They are some bars codes that are the same numbers. So 397, 597, they should always balance. Note, you cannot transfer to the fiduciary funds or vice versa. Those codes are not allowed when you go to file your annual report. So they're only over in your governmental and your proprietary funds. Now, also a caution is restricted revenues. So these are the revenues that you collect that can only be used for a very specific purpose. It's fine to transfer those to another fund as long as you know that those are being used for the reason in which they were collected. Those do get looked at. You probably have had your auditors ask you about a transfer from maybe a utility fund. What's the support for that? That is why we need to make sure that that money that has been moved, that is restricted, is being used for the purpose intended. So we have an account example. This one is pretty simple. You have our transfer out bars code 597. We are reducing cash. It's a debit for the transfer out because it's like an expense. And then we're crediting cash because we're reducing. And the fund that is getting that cash has, oops, see, I get excited, start talking. We increase cash, so we're debiting cash, and then we are crediting the transfer in, which is a 397 code, and then we balance. So the two funds have their two debit credit entries, and life is beautiful and wonderful. So reimbursements. So this is the last category of our interfund transactions. And this is when one fund, which we like to call the original fund, pays a bill or pays something for another fund, which is the responsible fund. There's lots of reasons that this can happen. Eventually, the responsible fund says, oh, thanks for paying that bill. Here you go, original fund. Here is your money back. The original fund never reports a revenue. They actually would reduce either the expenditure or the receivable account. If you're GAAP, you might use receivable accounts. So never a revenue when this occurs. And the responsible fund, that's when they record their expense. So let's take a look at that. Why would I do this, first of all? An error. This is common. Oops, that bill was supposed to be for the water fund. Or oops, oh man, that was supposed to go over to that parks fund. So we're fixing an error. Totally fine. You have found it, you're fixing the error. Or what we see often is cost allocation or administrative related reasons. Sometimes it is just easier to pay that cell phone bill and then down the road, like a month later or quarterly or whatever your process is to reconcile what needs to be settled, allocate it to the other funds. It is easier to just write one check for however big your cell phone bill is. So this is administrative, and that's okay too. So you're tracking it and you're making sure that that payment is going back. So at the end of the day, what we're trying to do is we're going to say this is the general fund. The general fund is the original fund that pays the bill. So they are getting a phone bill. It's $7,000. They are going to pay it on January 15th. But we know that $3,000 of it is the sewer's responsibility. So the sewer fund is going to have to reimburse the general fund, and they do that on the 25th of January. So what's happening in the general fund? The general fund only wants to record a $4,000 expense because only $4,000 of it is theirs. And then the sewer fund needs to record a $3,000 expense. So how does that all happen in our transactions? So the original fund is going to pay that bill. Now this is cash basis, what you would do. And GAAP, this is how you fix an error, because we'll get to cost allocation in a minute. So we are going to pay the bill. Expenditure out the door, and cash is credited, bill paid. And then the responsible fund says, I owe you money. So now they're going to expense their portion of the bill. They're going to reduce their cash. And the original fund, or the general fund in this case, they're going to bring that cash back in and they're going to credit that expenditure account. So if GAAP, this is why this would be an error correction and not to a receivable. Oops, I made a mistake. I paid a bill by accident, expensed it in the wrong fund. I need to reduce that expenditure. Cash, you don't have receivable accounts, so this is how you would handle your payments and allocations or an error if you're fixing an error. We good so far? Yes.
Yeah, right up here.
Hold it close.
Would this be the same for like somebody put something on a P card and then they reimburse because it's a personal expense? Would that be the same kind of thing?
Well, I'm going to defer you to your audit team on that specific situation, but Brad's going to cover his ears. In the accounting world, yes. It's got to get paid. They're probably not writing a check to the P card company. You are paying it and then they give you the money back, but please note that and please inform your audit team of that because that is not okay. Personal use on credit cards is heavily looked at. So, but yes, that's what you would do is fix it. GAAP governance, you probably use a receivable account to just say, I am owed this money, but same concept. You're paying something, somebody is paying you back. Great question. And Brad was singing in his head, so he didn't hear that. Okay, so GAAP, let's talk about reimbursements, kind of cost allocation, reduce administrative burden, lots of reasons why we might do this. So GAAP governments, you pay a rather large bill that's going to need to be allocated across many funds. So this is where most likely we see the due to and due from other funds being used. I highly caution expending in the paying fund if you're GAAP. You have receivables and payables, and this is a great way to use them. You don't want to over-report an expense in a fund. So generally with this, we see the paying fund expense their portion of the bill, and then we see them put into a receivable account the amount that the other fund or other funds are going to end up paying them. So they have 2 debits to equal the 1 credit, which is the cash going out the door. So when we go to settle this, the responsible fund is going to, the responsible fund needs to record this before we settle it. So they're going to expense and it's a due from because those due tos and due froms need to equal, right? They owe money. They need to record that in the period in which it occurred as our GAAP principles require. But it's when we go to settle it. We are now going to take the cash from our responsible fund, reduce cash, we're going to reduce our payable of due to, and we're going to pay the general fund. So general fund gets their cash and they reduce their receivable. So our debits equal our credits. Each fund gets their equal entries. So it's a lot of tracking. It's a lot of maintenance. It's a lot of balancing. It's a lot of double checking. But sometimes that is easier than trying to take a bill and expense it across like 47 funds, right? I worked at a city who was like that, so I totally understand the administrative burden of this. Sorry, Olivia, I tried to bounce forward. So we've covered the 4 main really quickly. Like I said, it's going to be like scratching the surface level. You might have a lot more questions. But before I pass it over to Olivia, any questions on transfers or reimbursements? They're all like, this is really easy. And then you'll think about it and you'll sleep on it and then you'll have questions. Please shoot your questions our way. We want to hear from you.
Okay, now we have special topics, which is really just code for things that people mess up a lot and we want to talk about. So the first one doesn't actually apply to you. This is utility taxes for cities, but I do want to pause here because really the lesson learned from this is if you have transfers out of a utility fund, go look at that. Is it really a transfer out or is that utility fund paying an expense? Transfers out of utility funds should be kind of rare because the money you bring into those utility funds is required to be spent on those utility fund activities. So if you're transferring that money to another fund, your auditor is going to question that and say, is that really for utility activities if you're moving it somewhere else? Because if it is truly for utility activities, utility fund should probably report an expense. if you're reporting transfers out of your utilities and you go back and you look at it, like, I don't know if this is right, submit a help desk. We can look at your specific situation and talk through it with you. Okay, the other thing that people often get confused is the difference between an interfund reimbursement and an interfund service provided or used. So remember, the reimbursement, that's non-reciprocal, but the service is reciprocal. And the accounting for these is different. So it's important to make sure that we classify our transactions into the right interfund category. Both the reimbursements and the interfund services provided and used result in the responsible fund reporting an expenditure or expense, right? Whichever fund is responsible for paying that expense, they're always going to report the expense. The difference between the reimbursement and service is what the original fund does. We're talking about a reimbursement. That original fund is going to reduce their initial expense or expenditure. In GAAP, you might reduce a receivable. But if it's a service, that original fund reports a revenue. So this makes a big difference in that original fund. Are they reporting revenue or are they reducing their expenses? I think one of the easiest ways to talk about this is to look at a couple examples. So we'll start with this one. We can say a county sets up an internal service fund to account for IT services. So that's like purchasing new equipment, paying the IT personnel salaries and wages. They then divide those IT costs amongst the various departments and funds. So that internal service fund, the IT fund, they're going to charge other departments for these IT services. So go ahead and take a couple minutes and chat at your table and decide whether you think this is an interfund service or an interfund reimbursement.
Yeah. Okay, where did we land?
Well, my table said that it was a service provided and used because it's the cost of new equipment, personnel, etc. That's what we thought.
Okay, anyone else? Did everyone agree with service? Yeah, this one's a service provided and used. So remember that internal service fund, they're set up specifically to provide those services to other funds. Like that's the whole purpose of even having an internal service fund.
But we did have a follow-up question because it says new equipment. In many cases, our Fund 502, which is our IT fund, will pay for a computer if it's not included in their cost allocation plan that is divvied out to everybody based on usage. If they say, if you want a scanner, you're going to have to pay for it. We'll buy it and we're going to bill you for it. But because it's a 500 fund, do we net that or can it stay as an expenditure there? And when we pay for it, also be an expenditure?
Yeah, so Stacy, stop me if I say something wrong. So because it's your internal service fund and the whole purpose of them is purchasing that equipment and renting it out to other funds or letting the other funds use it, it's still a revenue in that internal service fund.
And it would still be an expense when they purchased it.
Yes.
And then we would also, and then the other thing that I've always found is when they purchase all those little miniature items, like a scanner here and a headset here and a monitor here, it's not a charge for service. So they've been putting it in miscellaneous revenue. And then I've been kind of weeding through and trying to decide if there's a more appropriate line than that, because it's a miscellaneous reimbursement. Do you have any other suggestions for bars lines for that? If it doesn't reach the capital threshold?
So were you talking about the revenue or?
No, the revenue, sorry.
The revenue, okay.
Yes, I shouldn't have thrown in that.
You're good. So if it's, I would say use the 340 code because that's really the purpose of their fund. So anytime they're charging other funds, they should be using that 348 for the internal service.
Oh, I'm gonna go change that tonight.
Any other questions? We do have another example to look at.
Oh, sorry.
You're good, Heidi. That's perfect. Okay, example 2. This time we have general fund employees. They process payroll and accounts payable for the entire county. The cost of those employees' salary then gets divided amongst the various funds and departments. The general fund's performing some work for these other funds, and then they allocate that cost out to those funds. So go ahead and take another couple minutes, discuss with your table. Do you think this one's an interfund service or an interfund reimbursement? Anyone in the chat participating? Chat folks, you can put your input in the chat too, if you think it's a service or a reimbursement. It got quiet. Did you all come to a consensus? What do you think? Is this one a service or a reimbursement? Does anyone think reimbursement?
Well, we do this and we account for it. And what happens is we bill the other departments and say like the special revenue funds and, solid waste fund and all of that, we bill them for their accounting services, their wages, their benefits. And then also we track the Affordable Care Act third-party provider, what they bill us. And we bill it out based on the amount of time spent and the number of warrants cut and the number of employees paid. And so what we do is if it's still billed and received in the current year, we have to net those wages and benefits from my department, wages and benefits, and code them as wages and benefits. They pay them as a professional service, like Safe Solid Waste pays $1,400 as a professional service. We bill that out to wages, benefits, and professional service. And then we don't even code it as a revenue.
So you're treating it as an interfund reimbursement then. You're reducing the expense in the general fund.
Yeah,
that's the right way to do it.
To avoid a duplication.
Yeah.
Stacy helped me with that a few years ago. But the kicker is they have to pay that bill within the current budget year. If they pay you for 2024 in 2025, it's all off and it's instantly a miscellaneous reimbursement or charge for service or whatever, because you can't net from a previous year for this purpose.
Right. For cash basis governments, you can't net across fiscal years. GAAP governments, it's a little different because you have accrual.
Yeah.
Yes.
Oh, yep. Right.
Okay, I think I'm a little confused by this one. So Gap County, I said interfund services, but the way that we do this is part of our indirect cost allocation. So this year 13%, and it's all the external funds from the general fund, because that's where all of our central services lie, that pay 13% into the general fund. So is that not an interfund service, or?
Right. The general fund should not report a revenue.
Okay.
They should be reducing their expenses. And this is usually about the time where people ask, like, why? What's the difference?
Yeah.
We have a slide for that.
Okay. I'll wait till the slide.
So the difference here, and this comes from like GASB, right? SAO didn't make this up. GASB tells us how to do this. Overhead cost allocation does not qualify as interfund services because it's not a programmatic activity. So in our general fund, that general fund is not set up to sell services to the other funds or departments, right? That's not the purpose of that fund. But when we think about those internal service funds, what's the purpose of that fund? To sell services to other funds and departments. So that's our main difference here. General fund, it'll be pretty uncommon for them to be reporting a revenue from other funds. Most of the time it falls into this interfund reimbursement category. Of course, in accounting, nothing's black and white, so that's not a never ever rule. Just most of the time we wouldn't expect to see a revenue in the general fund. So if you have specific situations that you're wondering about, like, oh, our county reports a revenue for this, you can definitely submit a help desk to you and we can talk through your specific circumstance and figure out what the transaction is and help you classify it the right way. Any questions on that? Yeah, in the back.
I think I'm doing the same thing as you if we have things like this. Or do them as a 389, no 589, which actually is decreasing the expenditure line because I don't report those. They cancel each other out.
That doesn't sound quite right. You should be reducing the original expense.
Right, but I didn't even code it as the original expense when you have the 389 and the 589 and they just cancel each other out. Getting there the same way, but a different path.
Getting there the same way is fine. Yeah. So if you're not recording it to that expense in the first place, what's most important is we want those expenses to be correct in each of the funds and for that general fund to not be reporting a revenue. So if you're getting there, that's good. Any other questions on this one?
hang on, I'm not coming.
We had one employee who switched departments, and we needed their expertise in their original department when there was turnover. The new department that they're in is Public Works, and they bill out. And so we counted it as professional services is how they wanted us to treat it. But it truly is salaries and benefits. But are there any concerns in that scenario if that's their normal way of doing business? They counted it as another project, as if one of their staff was doing a roads project, they would bill out as if it was professional services. That's how they decided to treat that. Any thoughts on any exceptions to the rule on that, or is that?
So are you saying in the Public Works Fund, they report that as a service, or the fund that received that they worked in?
Both. So one thought was, wouldn't we just have salaries and benefits, that portion of the employee go to that fund? But instead they wanted to do it as professional services because that's how they build out all their other functions. Is on top of that, they were charging an indirect cost on top of that. So anyway, we can talk after if it's
Yeah. Typically, if you have employees and you're spreading the cost to those employees over the funds, you want the wages and benefits, object code 10, and they need to be reported in the funds that are paying for that expense.
And then when we bill, all of our departments that we bill for those accounting services, they pay us out of the professional services. And we break it out and we report it in there on the annual report as a wages and benefits coded to financial services, 514s. So sometimes they never even know because we send them out their final information for the C5, and I don't even know that they paid that close attention to it to know that they paid it as a professional service, but we dispersed it as wages and benefits to that function.
So your department is doing an entry after the fact to correct it?
Yes.
Yeah, that makes sense.
Yeah.
Sounds like Heidi has all the answers. If you need help.
My mistakes.
Okay, as you start thinking about this and thinking about the type of activity your government does, what types of interactions your funds have with each other, please submit help desk to us. We are happy to think through your transactions and work through what's the correct reporting for it. So we have some resources for you. The first one is the BARS manual. The overview page here on the screen, this is the page that covers all the information we just talked about. It tells you what reciprocal and non-reciprocal are. It talks about the 4 types of categories and how to account for them. We also have other pages, like we have specific page for interfund loans and for equipment rental and revolving funds. So there's a lot of interfund activity information in the BARS manual. For our GAAP government, you have access to the GASB codification. If you haven't visited their online codification, you really should. Significantly better than looking through old GASB standards. This takes all of the individual statements and puts it in one place for you to search, and it's by topic. So interfund activity is in section 1800, and it talks about the interfund activity. Your last resource is us. You can submit help desk to us. We love talking about accounting stuff. So if you submit a help desk and it's an interesting transaction, we can call and talk about it and go over the details. So if we don't have any other questions, one.
So I don't know if this is directly related to what you just went over. We have been appointed a receiver for a water system. It's in receivership. We're looking to have to, so the system is being managed through our public works department. We're going to have to do some significant maintenance and repairs to the system, probably like $750,000. We can then turn around and do an assessment on the landowners, the property owners, the members of the water system. And we're kind of going back and forth about the best way to do that. Don't know if there are others that have been in a similar situation, debating about whether to set up a special fund, do the assessment, because landowners aren't going to obviously be able to pay that $750,000, you know, so we're going to be assessing it over a period of time. Do you have familiarity with a similar situation, or?
So has your county assumed that water district? Like, do you account for it as like a special revenue fund, or is it still just a custodial?
It's custodial.
Okay, yeah. So that sewer or that department activity, that should be reported over in their fund, not in your county funds. If you're going to loan them money to cover the cost.
Are you writing this down, Reese?
Okay. That's an intergovernmental loan, and we have a whole section in the BARS manual on that. And are you GAP?
We are GAP.
Yeah, so on your books, you'll be reporting an intergovernmental receivable for the amount that that district owes you. So when you assess those landowners, the revenue is going to be reported over in that water or that sewer district. And then when you pay the county, that's when you're going to be reducing your receivable.
Very helpful. Very helpful.
Any other questions? Okay, that's it. Thanks for having us.
Okay, so we're going to take a 15-minute break this time, a little bit longer. And just a reminder, all of our snacks and beverages are inside our room. So there's another group that's holding a conference here, and their stuff is in the hallway. So don't get it confused. Ours is in this room. And so we'll see you back in 15 minutes.
Hey, ooh, sorry about that. It is 3:50 and we would like to start at 3:50 so that we can have a 50-minute session for our continuing CLE. And so that would put us off at 4:40. And then everybody can enjoy some time before dinner. Okay, so this next session is going to be a roundtable. And rather than just communicating at your table, I always felt like it was really productive with a small group such as this for us to have discussion. Chandra and I each have a mic, and we want to hear from everybody. And online, we would like you to participate by putting your comments, your questions, everything in a chat. In your chat, Chandra has some things to get the ball rolling, some topics. And what we're going to do is we're just going to throw something out there. And we're going to, if anybody has anything, and if we know you have something and you're not raising your hand, we might come over and stand by you. But we're not, this is not a pressure situation. So if you do not want to speak, you just tell us you don't want to speak. We're not into that. And you at home, if you would like to show us your face, we would love it. But there again, we're not going to force that. Okay, Chandra, what is our first topic?
So these are all questions that have come in throughout the year for the finance committee. And it's really more of a, what I don't want people to think is that we're doing a right and wrong here. So these could be things that are done differently, but what we're trying to do is kind of figure out if there's a consistency of how people are doing it. So the first question is for travel. When you have somebody who's doing a one-day travel, are a majority of counties pushing that through a payroll, or is that coming through an accounts payable? Yes, like a single day reimbursement, maybe a meal reimbursement, single day? Oh, okay, I like that.
Heather, I'm coming at you.
Do you want to say that?
Okay, so
on the record?
On the record, it's recorded. Ponderosa County does not reimburse for single day travel meals. You don't get, you're expected to bring your own lunch if you're traveling too far or whatever. You have to spend the night somewhere for us to reimburse your meals.
If it's single day, we reimburse through payroll as a taxable fringe.
What Heather said.
okay, so reimbursing it as a taxable fringe. How much pushback have you guys gotten? Because I get a ton of it, but we still do it. Is that what you guys do too?
Yeah, Benton County does the same thing.
Yeah. Perfect. The main comment I hear from my people, I'm paying tax on this twice. It's a different taxes. One is sales tax. The other is, it's a taxable fringe. And they said, and then their other thing, well, I guess we'll just start spending the night so we can get our dinner paid for. I said, well, take that up with your manager. Any other thoughts on this topic?
Oh, okay. So does anybody else have any questions now that we kind of started it? Does somebody have some questions that they want to ask? I can just keep kicking them off.
Hey, hey.
I was just wondering what, well, today in an email, we have a fraudulent check. So we, through AP, we process checks, we mail them out. We don't do ACH yet. I'd like to talk to anybody that does ACH for all your processes. We've been getting a lot from Thurston County sitting here. But so we have, what is it called? Payee positive? Positive pay. And so this check was actually totally fraudulent. My signature was wrong, was not my signature. The amount was wrong. Who it was paid to was wrong. So our treasurer every morning checks with the bank, and they rejected this check because they knew it was wrong, the amount and who it was paid to. So the county doesn't pay it, but we don't know then who loses that money also. Like, did their bank give them the money and now our bank is rejecting it? Oh, and this one was the veterans payment. It was supposed to be 500. It was 10,000 some dollars. Yeah. So what are your expenses with fraudulent checks?
So we had a check that we cut to Seattle Times for voters pamphlet, and it got sent to an old PO box, and somebody cashed it and the bank honored it. But it wasn't Seattle Times. So we reached out to our bank, who reached out to their bank, and they decided that it was fraudulent. Our bank got the money back from them, and it's up to their bank to then try to figure out, how to recollect it from whoever they gave the money to.
So basically, your treasurer did not allow that check to cross into the county. So really, truly, it's between the banks now. Yeah. Yeah.
We're thinking that we're hoping the ACH will help with that. Maybe.
There are risks in ACH too.
Yeah. And I think with the payee positive pay, you only have so much time. So we're talking like the day after Thanksgiving, county is closed, the banks are open. So our treasurer has to or one of the people have to either come in or they take the laptop home and have to deal with the checks on Fridays.
So if I can just add to it, because my concern is this is going to a veteran's family, and I don't know, and we're being told to void and reissue the check. But what I don't know is if that money has already been given to the family, then are we paying that payee, then are we paying them twice? And so that's my concern, is like, how far do we go down the rabbit hole on it before we reissue it? And because I don't know where it was hijacked. Was it hijacked between the two banks, or was it done before it was deposited? Well, it wouldn't be before it was deposited because it was rejected. But it's very possible when it's a business, I can see how that works just fine. But when it's a personal family, how do we handle that? And have you had that experience?
So we turned it over to law enforcement, let them sort it out. But, and we had that with a Blake check, that somebody intercepted the check from the mailbox. It was a trailer village, right? A mobile home village. Somebody interjected the check. And ultimately we ended up reissuing the check to the receipt.
Your county's only going to hit once. The county's only going to get hit once because you rejected it, or your treasurer's office rejected it. So you have an obligation to actually send that money, whether they get it twice or not. That's correct, because the banks have to figure that out themselves. But when it comes to the county, you still owe that money, or you're obligated to that. So still issue it out. Once you can confirm with your treasurer's office that it didn't actually go through, then you can reissue a new one.
I turn it over to law.
And so kind of along the same line as this, a little bit different, we know that there's, we're constantly moving people. And so vendors that we do business with are changing addresses and changing information all the time. But we're finding that a lot of these address changes are fraudulent and are not initiated by the proper people. So Does anybody want to talk about your controls about changing vendor information? Who can do it? How is it verified? Does anybody have any thoughts on this? Because it's becoming a problem. I know for us, we've made it to where our office is the only one that changes vendor addresses, even through Public Works that we import their payables. They export to us, and so we don't even change the vendor address. We've gotten to the point where, you know, we've taken an additional load on our office. And Courtney, if you want to talk about what you do to verify that's a proper address change.
Well, at first I request, most of the time it's coming from Public Works, sorry. And so she has to put it in the email. She puts the new address with the vendor information on it. And I just make sure that she either gets a W-9 or has spoken to the actual vendor before I change it. And then I just save the emails so far.
Yeah.
I'll put it out. Do you make sure the new W-9 has that new address? Because everybody has a different, companies can have a different remit to.
So if they do not match the W-9, I specifically ask the Public Works person if they confirmed it with a person and have her email that to me so that I have that verification.
Okay. Yeah, I typically go through each department. If a vendor wants to update their address, then I contact that department who's done business with them, making sure that they are aware, is this a good address to use and is this a good contact before I update anything. But their W-9 might not have that new address on there.
So Susie says from online, thank you, suggest physically calling the vendor outside of the request, normal contact.
Yeah, it sounds like that's a lot of what is being done by the departments. And really, truly, I think the departments need to do the work. You know, we cut the warrants, but they're the ones that requested the work, ordered the product, signed the contract. They know their vendors and they need to be doing that work.
What about when someone comes to pick it up? Like, what do you guys do for checks that you cut and they want to physically pick it up? Do you guys verify anything?
This is what happens a lot of times with our public defenders. It happens sometimes with contractors working on a project. They will come and pick up checks. Do you guys have that? Just a second, Race, I'm going to come back. Do you have any requirements?
It's typically with contractors because we have a lot of money going out. Obviously, nobody wants a $3 million check going through the mail. So we will contact making sure the department. So we have 2 people in our county actually doing business with a construction company. They escort the person coming, and they also put in an email of who's going to come pick up the check and bring their ID, verifying that that's the right person. So we make sure the department knows the person, and they all 3 come in, and then we have them sign something and date it before giving them the warrant. Just some documents that we actually keep just in case SAO ever asks it. So just name, print, sign, check number, and date. Something very simple.
Receipt, of course.
Like, just in our.
Are you? How long are you keeping them? Where are you putting? Like, what? Where's that document going?
We're keeping it in our A drive or in our drive, and then retention. I think we're doing it for 6 years.
Okay. Good.
We're just keeping it as a page fills up. Every time I do it.
But we just moved to a new financial system that we can probably just scan it and attach it to the record.
Yeah, to the warrant, yeah.
You could also do something like a check pickup log that basically has the person sign their name and then you do the ID so that you make sure that if you ever had to backtrack, like the vendor said, well, we didn't get that check, you can say, oh, yes. You know, Joe came and picked it up on this day. We have his signature. We checked his ID. It was, so he has it. Yeah.
We're going to be hosting a fraud training. These are good questions for those types of things.
And I just want to tell everybody, do not ever let your guard down. We have a wonderful payroll deputy who's been, payroll for, 30 some years. And she got a request for change of direct deposit. And she looked at it and she went ahead and processed it. Well, it was a green card. Is that what those are called? Yeah. Like the teenagers have. And so the payroll posted to that. And then the next payroll posted to that. 3 payrolls. And eventually the deputy reached out and said, I don't think I've gotten paid for a while. First of all, I would like to have his disposable income. And I'm like, dummy, what are you doing? And anyway, his, apparently his wife does well. But so anyway, we had to, the money was long gone. There was no getting it back. I don't think we've ever recouped any of the money from, risk management or anything like that, because it's a green card. It was like a prepaid Visa, it was gone. And so I'm just telling you, always be vigilant. Upon another look at it with the SAO, the deputy could clearly see that there were grammars and grammatical errors. The signature was kind of funny, but we're all so busy. I mean, you can just be over your head and you can be like, I've got to get payroll sent today. It's got to go to the bank today so it'll disperse on the proper day. And so you've got, well, I'm going to do Tomas's check right now because I'm going to process this new account because, oh my goodness, we have, everything has to be perfect for the employees. Well, pre-note that, cut a check, make him come get it. Give yourself a little time, but don't let yourself get in a rush, because that's when these things happen. And we got received a management letter during our accountability audit, just simply for the fact that we had a lapse in our procedures. And I agree with it. It hurts, but I agree with it.
I think though Heidi brings up a great point, and sometimes, especially for our payroll people, there's a lot of pressure to do payroll fast and very, very good, down to the penny, because not everybody allows 3 months to go by, but we won't talk about that. There's a lot of pressure there. And to hold firm to your policies that no, you have to come in and fill out a direct deposit form and it has to be a wet signature, I'm sorry, can get very spicy. We see it all the time. And I think it's important that as a unit, everybody says the same exact thing, because boy, they'll pick you apart if they find one person who has a soft spot in their heart that day. They'll take it and run. So, yeah, I know it's me. I'm just like, what are you doing? So, I would say, there's just there's a lot of times where you just, you need more support to back you up about following policies.
And throughout the years, this payroll deputy has caught hundreds of these kinds of requests. She's caught so many, and she has foiled their plans and not allowed these fraudulent requests to go through. But it's just one time, and she's still kicking herself. And I'm like, you know what? We all learn. I learn from my mistakes. I don't know about anybody, all of you. It hurts, but we've learned.
We were getting a lot of those emails, and fortunately, our system, our process is the employee actually has to log into our online payroll system and input their information. So we don't do that for them, and then it is a pre-note the first time, and then if that verifies with the bank, then it's active the following payroll. And really, it's the same thing with vendors when it comes to we do very few, like ACH. Our treasurer doesn't care for them, but if we have employee-like vendors like OPD, for example, where they have contracts, regular contracts, we do allow them to do direct deposit, and they come in and they do that for us. And because we had a major fraud years ago, it's very, very rare would we allow anybody to pick up a check, including employees. We were talking about, when we went to this new system, making everyone have direct deposit, which was we could have, but it was easier to say, if you don't want direct deposit, you cannot pick up your check. It will be delivered to your house. And so we only have one person that does that. So anyway, that works out well for us.
That's a good idea. Great idea. Has anybody else developed procedures or processes to avoid these situations, these bad fraudulent activities?
Yeah, kind of in line with Franklin County, our new, we're upgrading our financial software, and the Connect employee application will allow people to do it. So we will no longer accept emails, phone calls, any of that stuff. We'll just route them to that portal.
Perfect.
So this is about the warrant reissue. We have every person, when we reissue a warrant, sign an affidavit that they did not receive funds.
Yeah.
So.
Do you guys have a policy for how long you go between reissuing checks? Like, do you have a, or is that all through the treasurers for you guys?
We process warrants daily. As soon as they can receive it and verify it, then they'll reissue.
I'm not sure which question.
So looking online, it wasn't really a question. They were just stating that for any reissued warrant, they require an affidavit.
Just to add to the open warrant or the affidavit for the warrant, we also attach an open payment report and screenshot that the check hasn't been reconciled, just for backup that we did verify that as well.
Oh, sure.
Well, one thing on the affidavits is when you have a bigger company like Verizon or something, trying to get an affidavit from a place like that is nearly impossible. I wondered if anyone had ideas about that.
Yeah, CenturyLink. Has anybody tried to get a hold of CenturyLink?
No, but we did have one from the sheriff's office where they could not get it done, and eventually they just had the sheriff or somebody sign it stating that it hadn't been cashed and that it had been so many, and then we reissued it.
Yeah, that's a good idea.
So on another note, I will ask another question that had come in, especially for the smaller counties and kind of as we start to see budgets dwindle. There was several questions about indirects and how they're charging, how you guys are charging them. When do you charge them? And what kind of documentation are you using to charge indirects? So if you're charging it to a grant or you're charging it to a different fund, what kind of documentation and all that are you using for that?
So every year we do an indirect cost allocation. And so that's what we're using. If it's used with a grant, they request it. We will just attach that with the A19 and submit it with it. We've really never had any issue. It's audited by the state auditor. It's published. And yeah, we use it pretty much across the board on most of our grants, except for public health. They have their own indirect cost allocation. So.
And do you just charge it across the board every grant?
We weren't. But now that we have actually a grants administrator who is now working with people that process grants throughout the county, we are definitely charging it, especially if there's a budget for it.
Did you receive pushback that all the money couldn't be used for the grant project, as you were taking some of their money? None?
She said usually there's budget in the grant for administration costs.
I will say from our county, we get a lot of pushback, Joe, that no, that we shouldn't be doing that. However, budgets are looking a little different. People are looking a little different.
In our county, we use the de minimis rate as allowed, and it increased from 10% to 15%. So, and I have never trued it up to see, where are we at on that. So I haven't had any pushback from the departments.
You don't know what my question was. Okay, so here was one. Apparently, some counties do a 13th month and some counties don't do a 13th month. And I am wondering how those without a 13th month process. There's stuff in January that's for December. How does that work? Because I love your brilliance. Does everybody do a 13th month in here?
I can take.
We just attach our open period items to period 12.
Oh. So you're still keeping your opening, just like you're still keeping your period 12 open. You're just not doing a 13th period. Gotcha.
Yeah.
Gotcha. So does anybody close right at 12:31? And okay, let me hear about this.
I did because Darla said it was a good idea.
We used to have a 13-month.
And we used to have a 13-month and we don't anymore. And we like it better.
Yeah, but we're cash.
We are cash.
We are cash also.
They don't push back with to me.
I got pushback when I discussed it, and I got pushback because they said it was in RCW. And so I
It says
can't-
it's up to the auditor's discretion. So, but what do you do about payroll? Do you have payroll that crosses? Because we've talked about, maybe not doing it for AP, but then what do we do about payroll? Because we pay twice a month. And so on January 10th, we pay for the 16th through the 31st of December.
We pay on the 5th for the previous month, but we post to the previous month.
So payroll you post back, but you don't have an open period for AP.
Right. Yeah.
No,
But it's 2024 budget. I want in my 2024 budget.
no, we just budget based on that. Because when I do the budget, I do everyone's salary and put it in their budget. So I count for the one pay period that has the old rates. And
So you're posting your payroll back.
no, we pay it in the 2025, the last December, half of December. We pay it in January 10th of 2025, and that's 2025. For reporting to DRS and stuff, you would include that, but for our accounting, it's 2025.
Well, when you think about it, the IRS, they reset.
Yes.
And so it would balance with your payroll there.
Right. For the grants, any payments for those, we would notice that first 20 days, and any grant payments we do include?
I feel like most of my departments are out of money by the time the open period comes. And I don't open up the next budget till I'm through with my open period because I can't seem to keep everything straight. So most of my departments don't have any money left. So they're kind of sitting there waiting. So it works okay, but I probably would get a good response if we did not observe an open period.
So online, Mark said, going back to cost allocations, I had a question regarding risk management costs. We account for our risk management costs within an internal service fund. I was curious how other counties are determining the fair and proper allocation percentage to use in allocating their risk management costs to their various funds, particularly the roads fund and general fund. I can say from Lincoln County, we have a spreadsheet that takes about a day and a half to do. That allocates it out per L&I wage codes and per actual buildings and equipment and yeah. Anybody else?
So our general liability premium is allocated in the year that we pay it, and it's allocated based on L&I costs or hours across funds. And then our property is done the same way, like vehicles and all of that. And the general fund pays for the property unless it's for most of the property. I'll just leave it at that. And then, but the premium is distributed across the other funds, and then it's reimbursed to the general fund, their portion. So that's how we do it.
So it seems like there was some other L&I. Did you guys use L&I too as your breakout?
Use L&I and pay the general fund out of my auditor non-departmental and then charge the rest of the funds their portion.
We also use L&I, but it's for the last audited year's L&I, so a little bit of a delay.
I don't know about you guys, but when we're talking about cost allocation here, one of the costs that we allocate out is our state auditor billings for the financial and federal and accountability audit. And we allocate those costs out to the different departments based on their percentage of the overall approved budget for the year that they're auditing. And it's worked okay. And then we establish a percentage and we apply that percentage to the billing just to make sure that, because it's not fair for the general fund to pay for the portion of the road fund. They have all of the grant dollars that it's usually the road funding that's granted, that's audited. So we even cost those out these days. Or we have for a long time, I suppose.
For the audit costs, we have our auditor tell us who they're auditing, like they divide their hours by department, and then we send them the bills that way.
That's a good idea. I don't know if they would give us like a total breakdown of the number of hours. And it gets a little bit sad when they say we're going to do the veterans fund. And you're like, well, I hate to do that, but okay. But so that's why we just apply it and we have the different funds. And so say we'll put all the public works funds down and we'll send them the bill and then they divide it as they see fit. And we'll give them the cost breakdown too.
Lincoln County does ours off of this audited C4, off of the revenues and other sources. That's how we bill our audit costs.
I've never even had this SAO ask me about it because I'd say, seriously, you're going to audit the way that we distribute your bills? And then, I'm sure that there are other more important things.
And then back online, would Lincoln County and/or any other county that tracks the categories of cost be willing to share their risk management allocation spreadsheet? Who was that? Rebecca Turner? Yes. Lincoln County can share the spreadsheet, but it's going to come with instructions. It's so convoluted.
I can see what ours looks like.
Yeah, ours was done about 20 years ago, and I haven't updated it since. And I really do need to because it's sad. But it does the job. Do we have more? Is there other questions? I can keep going. Treasurer fees. Are people charging those separate or net? When the treasurer charges a fee for like changes in investments or something like that, when they come through, are you charging them net or are you charging them separate?
Our treasurer is just starting to charge different fees, so I don't have anything.
So is ours. So maybe this is a good question. Is anybody currently charging fees as their treasurer? Yes. Yep. The minimum? Do you net it or do you do it separate? It's charged separate. Okay. So you're using like a whole separate bars number when it comes through? Okay.
This year, just because of the.
Thank you.
Oh, here, Heather, this is important because that's the same with ours. Because that's a big deal.
Ours is looking at charging for junior districts, but not internally within the county.
And then we could talk about junior districts for a while. That's always a hot topic at this conference. This year, so we no longer provide payroll services for any of our junior districts. We just said no. And part of the problem is because of the tax ID number. Some of them weren't getting their own tax ID number, which. And the other problem with that, with doing there is all of the different programs. So Washington State, the paid leave programs, we did not want to be the ones managing those leave balances, leave banks, the usage and all of that. So we said, no, we're not doing it. So we offloaded that back to the districts and suggested that they contact their local accounting firms. And many of them are utilizing those local accounting firms. But it does cause a problem when you're helping them with their annual report or when they're supposed to be doing their annual report, because they have a separate payroll fund that then they request a check and they deposit that into their payroll fund. Well, that payroll fund or any balance in that payroll fund needs to be reported as an imprest or as a cash fund, as cash on hand. And so then you have to eliminate the transfers between the county treasurer fund and the deposits and disbursements between both of the accounts. And so I found that many of our junior districts can't quite accomplish that. And that's been problematic. I've been helping most of them do that with their reporting. Oh, yes, Heather.
So we only do AP for the junior taxing districts, but they include their payroll as part of AP. So they functionally process, what the withholding would be and all of that. And then we cut the warrants for the paychecks. And then when it's time to pay their 941, some of them do it electronically, but those sorts of things. So they process payroll through us as a function of AP.
A lot of ours wanted to be able to provide direct deposits and all of that. And so, yeah, but that's a great idea. Kind of helps them out with the reporting piece. So then we still cut warrants. We cut warrants for our junior districts, and we've started charging them. And based on our cost allocation plan, time studies of employees working on it, we don't really work in any supplies or anything like that because we mail the districts, the checks back to the districts. So we have started charging them, and we did get some pushback because they always go back to the old, but in the RCW, it says the auditor is required to issue warrants for all the districts. And I said, well, yes, but that's not what we're doing here. We're doing a whole lot more. And then I issue that, I list list down all of the services that we're providing in the issuing of the warrants. That just happens to be the outcome.
I don't know how many counties were, we had a meeting with SAO. They wanted to reach out to different counties to see what they were doing for junior districts. And my main question to them was, if they are going to set some sort of guidance to have us all do the same thing, to maybe meet with us so we can all be on the same page, because it's not a one size fits all for the larger counties and the smaller counties for what we do for the junior districts.
We met with them as well, and one of the questions I asked was whether they're starting to, because they've had a lot of fraud with these smaller districts. We just had one with one of our fire districts, and the gal that Heidi, was that her name? I can't remember her name. Yeah. I reminded her, and maybe she hadn't been around long enough, but there was a time we used to audit. Okay, now I'm aging myself. We used to audit the expenditures for the districts, right? So not only did we issue their warrants, but we actually audited the expenditures. And then the state auditor said, stop that. You don't have a responsibility to audit. And so it's just a pass through, right? And so she was interested to find out that information, that, we used to have a responsibility. Most of the counties did audit their expenditures.
And one of the reasons that we audit, but and we don't necessarily audit them, but we vet them, because if you pay the wrong amount, we're the ones that are going to end up fixing it, because they also, that's a problem there too. Go ahead, Brian.
Have you guys had any, or I guess, what are your opinions on pushing your districts that meet or exceed the revenue thresholds to do their own issuing and payroll services? So our largest district in the county, aside from school districts, is Fire District 2, KVFR. And we do more for them than we do for anybody else. We actually do their direct deposit. And it's kind of been an ongoing thing for years. I'm a fairly new auditor. They just got a new chief. So we approached them and just pretty much said, hey, we'll be reasonable with the timeline, but you need to look at a transition and start doing your own. So I don't know what anybody's opinions are on telling districts that meet the thresholds that you need to do your own.
I didn't even look at a threshold. I just told them they need to be doing their own.
$250,000 in revenue.
Yeah. I still
think that's
just
quotable.
said they're going to need it, because we were just having tons of problems with little park and rec districts that hire 50 lifeguards, and then we're getting their payroll, 10 minutes after we were supposed to send it. And then we have to go through and make all the corrections, because they don't normally, this is not what they do. They, provide a safe place to swim.
Maybe this is a good time to open it up for junior district complaints.
Yay! All hands up.
We'll go the rest of the time with that. Or maybe some best practices. Does anybody have any of those for junior districts?
One of the things that's come up for us is we have a water district, and I came very ill prepared today, but I could come back tomorrow with the information. But they were going through their audit, and this is the Othello Water District, so they have quite a high revenue and a big service that they provide. But they received a finding because they don't issue their own payroll. And apparently in the RCWs, the establishing RCWs, it says that the auditor has to issue their payroll. I probably said that wrong just a minute ago. And so the auditor actually called me and said, I just want to verify that you don't do their payroll. I said, no. I said, I don't. And she said, well, why not? I said, because I don't do it for any of my junior taxing districts. They have their own governing body. And she said, well, they're going to get a finding because you don't do it. And I said, well, I'm not going to start doing it just because they're going to get a finding. And so it's something I wish Brad was in here, because it's been a discussion amongst, it's not in all of the RCWs for all those types of districts, but it is in there for the water districts. And I'll bring that tomorrow, and maybe we'll have a small window where we can discuss it, because I felt bad for them. that they were going to get a finding, which could affect the grants, but I'm still not doing their payroll.
Heather from San Juan said we just stopped payroll services in 2025 for junior districts. Stop doing it. Too much legislation and liability.
Can you guys hear me?
Yes.
Oh, cool. Okay. So, hey, just for those of you that have really struggled with your junior taxing districts, we just spent over a year really researching RCWs, WACs, everything related to what we are statutorily required to provide the junior taxing districts. And of course, it is, they really lean on us, and they really think that the county, we are a county, is the authority, and really it's the state. And so they would be asking us questions, and their unique needs per each junior taxing district was different. We had 29 junior taxing districts that we were processing different needs, requirements for, and we just couldn't keep up with it anymore. So we took over a year to do the research for each individual junior taxing district, and we just essentially had to cut them off. It just got to the point where they were relying on us too much for essentially everything. And we just finally pushed back, and we have, I think we were a big part of why you guys are kind of hearing from the state about it, because we started reaching out to the state for guidance, and they really didn't have a lot of guidance. And so we provided guidance that we found, and it's becoming a statewide movement. I'm sure you guys are hearing a lot of this, but we don't want to be the authority for the mistakes that they're making. And there's a lot of liability in the payroll processes and what we were doing for them. And so that was a big part of why we decided to cut those services, besides the fact that the legislation on payroll in Washington state is insane. And trying to keep up with that in 29 different junior taxing districts was impossible. So you guys are welcome to reach out to me if you guys have any questions or concerns or need some guidance. Our team is, we really put a lot of energy into this, and we did get a lot of pushback from our junior taxing districts, council, the public in the islands here, but they needed to kind of take the responsibility on, and even as far as like they're reporting for their annual reports, they ask us questions, but it really isn't our responsibility. We are not the authority. The state is the authority. That's all.
Yes, preparing their annual report is another topic. Yeah. I mean, these are all volunteers. Many of them are volunteers, and that's really tough. And I do help them with their Schedule 01 a lot of times. It's hard.
But Heidi has a big heart.
I had a big heart. I really did. And then I couldn't keep up with it anymore. And it was impacting our movement and it started impacting what we were trying to accomplish. And I cannot be held responsible for the mistakes that they're making.
True.
So Heidi touched on this briefly on the tax ID issue, and some of you have financial systems that are capable of operating under two different tax IDs, but Cowlitz is not. So there is one piece that you should be aware of. Cowlitz County was fined by the IRS an ungodly amount of money right before I took office for processing payroll for your junior taxing districts. So it was very easy when presented with I want to say it was $86,000 that Cowlitz had to pay in installments. Your jurisdictions didn't step up to foot that bill on our behalf. The county took that on. So it was not a tough decision to say, you're cut off.
Yeah. Agree.
I will say too that I used to do a lot of vetting for our junior taxing districts, and I got a nasty letter from one of their attorneys stating that I was overstepping my bounds and that I should just stay in my lane. So now we don't do anything for them. We process them. I don't care if they're wet signatures or their stamps. They come in with their commissioner approval and they get processed. It's on them.
Yep. They have their own governing body.
I'm down to one last question. That's it. Oh, yeah.
I was just curious. We, our treasurer's office does the investment portion for our junior districts, and they'll bring in their approval to us, and we let the treasurer's office know there's an investment needed because they don't have anything in their fund. The treasurer's office is trying to figure out how long to do an investment. Like, do they do it on certain days? Because that holds us up from processing the warrants. So we get backlash from the districts. You know, some of those people depend on that money. Is there policy anywhere that anybody has that you hold the warrants for 3 days before you process, or the treasurer's office has to do an investment within 3 days so we can do ours? I mean, obviously we do ours in between our actual AP, so sometimes that holds it up with workload in that respect. But I didn't know if there's like a time frame that most people process junior districts based off the investments that the treasurer's office is doing.
So are you saying you guys process the warrants and then you hold them until the funding's in their cash account if they have to move money from their investments to their cash account?
No, we let the treasurers know that we received a warrant request and that they need to do an investment. But say the treasurer's office just received 3 junior district requests and they've already done investments that week. So now they're going to want to wait until the next time they do an investment, because you don't want to do investments every day for them because you just be moving money back and forth all the time. So sometimes if they did it on Monday, now they're not going to do it till the next Monday. Well, then now we've held them for a week, and then
Well, they do them on Monday, so you have to get it here by this time or we're not running it. I mean, that's what.
Yeah.
I would just tell them, you have to have it here by this time. And if you can't get it in, you're going to know you have to wait till the next day for the investment or whatever day you guys decide to do it.
Yeah. I mean, a specific calendar. We have a calendar for our junior taxing districts. So they only submit EFT requests on Tuesdays by 10 a.m. And that's just it. They just know that every Tuesday by 10 a.m. you have to have your request in by 10 a.m. or it's not happening until the next week.
I like the calendar idea. So is that like online form, or where do you hold the calendar?
I have it. We send it out. I'll attach it in this. I'll attach it in this thread here. It's when we transitioned, we had a whole packet that we gave to everybody to keep them organized.
What was she
She
gonna?
probably didn't hear you.
She asked if she could share that back.
Oh, would you mind sharing that packet?
Absolutely.
Oh, there was also a comment online. Oh, that was Heather, that we did 3 days too. Any other questions? I know you guys are just dying to ask something.
I think this has been a great session. We've gotten a lot of really good collaboration and ideas and tools. And
Heidi and I are going to go back and implement them all.
yeah, you bet. You bet.
So that wraps up today's session. We have dinner tonight. It's casual, so relaxed dinner and networking. And we start tomorrow at breakfast from 7:30 to 8:30. And where will breakfast be? In here? In here. Don't eat in the hallway. That's not our food.
So dinner is going to be located right out. I know we've been telling you everything in the room. And I'm glad Darla clarified, but the dinner will be in the hallway. So actually, when you go to exit, if you exit on the further doors, you're going to run in, like, if you take these doors, you're going to run right into the buffet. So exit out the doors on the other side, you can come around. Dinner will be served at 5:30.
And sessions start tomorrow at
8:30.
8:30.
Breakfast from 7:30 to 8:30.
So perfect.
Thank you.